Let's talk about this Yardi Matrix report. They're talking about how things have slowed down. And I'm just going to read this whole, it's a long paragraph, so just bear with me. But asking rents in October crept up by an average of 0.16% over September, continuing the deceleration of rent increases that we've seen over the last several months. However, this slowdown is very normal and expected for this time. It's very normal and expected for this time of year. It is only unusual in how quickly the deceleration has occurred. In fact, according to Yardi Matrix data for the decade between the Great Financial Crisis and the COVID-19 pandemic, the average month-over-month increase in asking rents in October was only about 0.08%. So while the pace of increase has fallen dramatically, the actual level of change has not, and is realistically still elevated on a historical basis. However, and this is the part that I highlighted, however, slamming on the brakes in a speeding car is going to feel far more jarring than slowing down in a parking lot, even if the final speeds are similar. Yeah. So, yeah, we've been cruising at, 120 miles per hour and, pulling the handbrake. There's a little bit of a different feeling in the vehicle than of a slow roll to stop.
Yeah. And again, it's like this psychology, and you can't blame people also because, and this is my big question mark. I don't think it's going to happen, but what if we continue this, what it is, a seasonal rent deceleration? What if it continues in December, January, February, and it never picks up? That's the fear, I think, that is driving these people to get redemptions.
Which, I think that that's not on your radar, and if you're not baking that into your pro forma, I think you could be missing out because, something that's kind of universally been predicted is, some sort of recession in 2023. The consensus more recently, as in like the last couple of weeks, is that, well, maybe we're going to be able to stick a soft landing. It's not going to be that bad, maybe.
Yeah.
We'll see. That narrative changes. Like literally 2 weeks ago, it was a soft landing has been taken off the table as an option. And then now it's like, well, it looks like that soft landing, maybe no one knows. Yeah. But if there's a recession next year, when we're basically in a stagflationary environment where like some costs are going to be going up, but maybe rents won't be because they've gone up so much over the last 18 months, 2 years.
Yeah. Again, it's just another case where having the right time horizon, and because none of the reports that I've read are expecting a multi-year, several years of stagnation.
No. Every single data report from every single source is that, because of just like the macro environment next year, right now, next year may be a little bumpy, but over the long term, the fundamentals are like very clear in terms of supply and demand, housing need. We're going to be in a good spot, over the long term. And so today, the risk is, so there's a risk. Do you buy now with the risk of needing to hold on for a little while because we don't know when the market's going to recover? It could be next year, it could be 3 years from now, it could be 5 years from now. Or do you just sit out, lose on any opportunities to buy anything, and maybe you miss out and dodge a bullet and you're able to buy prices when they're even lower?
Yeah.
Could be a good opportunity. Or prices don't decrease and they keep moving up, they're flat, and then they eventually continue to rise. You've just missed out on buying a lot of assets.
Yeah. I have a question, and I've probably asked it before. Do you think that that people are more nervous now than they were at the beginning of the pandemic?
It's a good question. I think it's different because in COVID there was so much fear about just like the virus in general and what was going to happen, and I think people were like rushing to conclusions on some things, and people were just like stopping. Because people were like literally like everyone stopped.
Nobody knew what was going to happen.
No one knew what was going to happen. Everybody got sent home. And everyone's like, we're not doing anything, and you can't go on site. There's nothing that we could even do. Yeah. And so people were just like, well, I'm just not going to be buying anything because it could get really bad. We're going to look at collections. Everyone was the fear was no one's going to pay rent and like collections were going to be like 50% or 70%.
Yeah.
But that ended up not happening. And then everyone looked around, and a lot of people missed out on opportunities in 2020. We picked up some great deals in 2020. In 2021, everybody woke up, and it was a feeding frenzy, FOMO, driven by low interest rates, tons of money sloshing around. now it's again, it's more of just more traditional economics, and cycles are starting to come into play, and people are just looking at it as, if interest rates rising, like that's the major driver.
Yeah.
I mean, back in 2020, interest rates were low and they got lower. And I remember when the 10-year dipped below 1% in 2020. And I think I put a video on like Instagram or something saying like, what this means is borrowing costs are going to go down. It means people can pay more money for apartments. This means that our prices have just gone up. Well, they hadn't gone up in a realized way, like we were just talking about. They don't go up until you actually sell them and you realize the gain.
Yep.
But the opposite is happening today. Interest rates are going up, and so if that same logic applies, well, the values are down.
Yeah.
So I think that the uncertainty and the fear is driven a little bit more by economic realities.
Yeah.
Multiplied by uncertainty.
Yeah.
Rather than, I mean, just compare to that same equation back in 2020. And the economic realities, but the realities were, again, the interest rates were low. People were still paying. And then just, time multiplied by the uncertainty at that point. Yeah. Which is a lot of different types of uncertainty.
Oh, so, I hate to say it's like it was way more of an unknown. Yeah. Now it's like we kind of know we have a worst case scenario. Yeah. And it's a lot more realistic and a lot more compelling in some ways than this blank. You don't know what's going to happen after in the pandemic. Yeah. And people quickly realized, and they kind of bounced back from that and realized what the opportunity was.
Yeah, I agree. People definitely bounce back. And also, if you just look at like the chart of anything, it's like, well, we were here and then, we went way up here. Yeah. It's like, what usually happens when that type of run? Yeah. Like, what usually happens? And I think everyone was like, it's going to go here, and then it's going to go here, and then it's going to go here. Yeah. And it's like, yeah. Doesn't work like that usually. Even in things that can be, moving in the right direction. It just, the market overvalues something. Yeah. They put a premium on it, as they did in the pandemic. They're like, multifamily makes so much sense. Let's jump into it. Oh, we're paying 2%, 2.5%. Well, I can pay whatever. And then, there's 20% rent growth. So I can pay a 3 cap or a 2 cap because I'm going to get 20% rent growth for the next, 5 years, which why anyone ever thought that is beyond me. So it was just like an ether, fever dream, fear and loathing style. Like, let's just go and
I agree. I specifically remember talking about this in it was like late 2021 almost. And it's like, what are we gonna? Everything keeps going up and up and up. It's like you get kind of nervous and like waiting for something to happen. And we thought we were being a little aggressive. Like usually people call us conservative, but like we felt like we were getting aggressive. Yeah. And some of our investors who weren't up to speed on like what was going on in the market, they're like, man, some of these assumptions are really strong. I'm like, I know they seem crazy, but this is what's happening right now. This is what's happening like right now. We're not forecasting for future years, but like this is right now. This is happening. And they're like, I don't know. And then so we're like, all right, this is the price. We're going to have low cash flow going in, but we think it's a good deal. And then, and our offer is $1 million. I'm just taking an example of many examples of deals we tried to buy in 21. Yep. We're like, okay, it's $70 million whisper price. We're like, all right, well, okay, 71. Yeah. 71. Like the deal gets brought to us first, and they're like, hey guys, I think they want to move quick. And in our mind, I'm like, okay, I'm sure they're gonna bring it to market because everything gets bid up. And they're like, but like, we'll put an offer in front of them right now. Let's get going, sign it up. Let's get moving. $1 million over ask, which usually like the deals might get to asking price like at the end of like a best and final or like just under. $1 million over ask, $1 million hard money, non-refundable. Now they're gonna bring it to market. And then it goes like $6 million over the asking price. I remember you started saying these numbers like, oh, I remember the story behind these.
We're like, what? Yeah. We're like, okay, it should have gone for 70, which was a crazy valuation. We reached a 71. And then you say went for 77. Yeah. And we're just like, how does that buyer make sense of that? And sometimes I would ask, but sometimes we'd even know the buyers. Tell me how you made sense of that. Like, love the asset. It's a great property. But like, how do you justify that? And they're like, well, it's like a generational play. Like, we're buying it for the long term.
Yeah.
Like, we're going to hold it for 20 or 30 years.
Oh, wow.
Like, we don't really care about cash flow, which is like, and I get all that. I get the first part that we're looking for cash flow because our investors are looking for cash flow. So it's like, it doesn't work for us, but it takes that. I mean, it shows, I mean, you can't just pay anything for anything.
Yeah.
But if you do have a long-term vision, I don't think too many people would say like the price for an apartment unit. Let's say they paid a 10% premium.
Yeah.
I think that the price of an apartment unit is going to be up more than 10% in 10 years.
Yeah.
It could be, I mean, if we look at history, it could be up 50, 60, 70% in that period or even more. And so that's they're probably coming in with a low leverage. So it's a relatively low risk investment unless you have to sell. We're all talking kind of full circle of like, if you never want to be a forced seller, you want to have it all the time on your hand, and you want to have a horizon if you want to ensure success, if you want to hold if you want to make sure that you're going to make money. And we've talked about this a lot, that might limit your maximum return. Sometimes, not always. Sometimes you have flexibility, but sometimes, like if you fit, like let's say you put a HUD 223F loan on it, which most syndicators don't do because one, it takes a long time, it's a lot of brain damage, it's a lot of work, but you can get 35-year amortizations for 35-year terms, but the prepayment penalties can be expensive. It's like 10% year one of the loan amount. It goes 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. For every year, it drops down a percentage point. Last year, it's 1 or it goes away.
Okay.
But there's a lot of syndicators. So let's say the value goes up, pops up in year 2. Well, you're paying a 9% prepayment penalty.
Yeah.
The value has to go up so much to get across that threshold. But you don't have to worry about debt or interest rates for 35 years.
Yeah.
So, you're trading the ability to pop it around, pop it next year. And you still could. You could sell on an assumption. The loans are assumable. But, a lot of buyers might not want to assume that loan.
Yeah.
So you have to assume it's going to be you want to assume it's going to be a 10-year hold. Lower risk, but where you're trading is not being able to punch 50% IRR in 13 months.
Yeah. Still a lot more, a lot less aggravating, a lot less scary to me.
Yeah,
than,
I think
having people able to jump in and out.
Yeah, no, and I totally respect the guys that are they're getting in there, fixing it, flipping it out, just churning and burning. Like, if you can do that, like, you can make a lot of money doing that. You can turn a lot of capital and grow a lot of capital, but risk equals return kind of at the end of the day.